And now, without further ado, please welcome another very strong panel on the financial stack of the future, on how banks, public chains, and enterprise systems can actually connect to realize all of the promises that we have made during the day. And please give a warm round of applause to Tamara Schmidt, DEA's very own, and her esteemed panelists. And with that, Tamara, I hand over to you.
Great. Good morning, everyone, and welcome to our panel. So, the future of financial stack, how public chains, enterprise systems, and banks connect. And so if you look at the financial infrastructure today, it's no longer just banks and payment networks. We now have public blockchains, tokenization platforms, cloud-native systems, and programmable money, and all evolving in parallel. And the big question is, how do these pieces actually fit together? And who ends up playing the central role? And I'm here today joining by this fantastic group of panelists with very different perspectives. So perhaps you can start with a brief round of introductions. Tom.
Hello, everyone. My name is Tom Judy. I lead product development at Google Cloud for capital markets technology. We're building a few differentiated things to allow 24/7 movement and settlement of value for our partners. We're building a ledger. We're building a custody solution where we're taking care of the difficult cryptography. And we're integrating this very, very thoughtfully with AI features.
Hi, everyone. Great to be here today. I'm Nick Kerrigan, Head of Innovation at Swift. I hope Swift doesn't need too much of an introduction for this kind of panel, but we are the world's largest financial messaging provider. We connect 11,500 banks and corporates across the world, over 200 countries. We operate at considerable scale, so we see an equivalent to the world's GDP pass over our network every 2 to 3 days, and we do that in a really highly resilient way, so operating at 4 nines of resilience, 99.99%. And as you also know, we've been working really hard on improving cross-border payments. So 75% of the payments across our network reach the end beneficiary in under 10 minutes now, sometimes in seconds. And we're not standing still. We are uprating the existing rails, and we're also creating the rails of the future with a new blockchain-based ledger. So really pleasure to be part of this group today. Really exciting discussion.
Hello, everyone. I'm Marius. I'm from the Ethereum Foundation. Ethereum Foundation is a non-profit steward of Ethereum, the protocol, and its ecosystem. It's great to be here as a protocol for the first time. So I've spent a long time with BaFin and with crypto custody previously, but now I represent Ethereum, or the Ethereum Foundation, which hopefully also doesn't need any introduction. But within the Ethereum Foundation, I'm on the enterprise team. We act as a sounding board for institutional participants, actors, banks, anyone that is exploring the technology that need help navigating Ethereum, the blockchain, its ecosystem, and we try to be helpful in navigating those conversations.
Ivica Aracic is my name, so I'm CTO at SWIAT, and where I'm investing my energy and time the last decade, so to say, is into bringing the puzzle pieces together that the regulated environment and regulated institutions need to scale digital asset use cases. And so basically it consists of having the infrastructure, and not only in the terms of just having some technology packaged and being thrown over the fence, but also looking how this shared utility in the form of a blockchain and DLT can be governed and operated at, let's say, European scale. And This initiative also has a name, so it's called Regulated Layer 1. So that's one part. And the second part, so that we do at SWIAT, is to provide tokenization and settlement engine. And let's say one of most notable issuances that have been done on our platform is the Siemens bond, the 300 million bond, done 2024. And additionally to that, so we also provide financial services in a sense of being crypto securities registrars. So crypto securities, it's a very German term, yeah. So it's under Electronic Security Act here in Germany, so EWPG. So that would be my side.
Great, thank you. So to set this stage, I'd like to get a quick perspective from each of you. So in one sentence, what will be the most important layer of the future financial stack? Tom.
I think that's a very difficult question to answer in one sentence. I think there's, like, if we look at the financial system today, the only thing that's very clear is that consumers and corporates alike like choice. There's a lot of choices, there's a lot of different technologies applied for different use cases. I think this is going to be very true in the future as well.
Nick?
Yeah, I agree with wholeheartedly with Tom that you can't answer that in one sentence, but I think the future financial stack is actually becoming clearer, and I kind of see kind of three layers to that, right? I think that there's going to need to be at the top a trust and governance layer, and that's not going to go away. That may look a bit different. You know, you could think about trust based on verifiability rather than authority purely, that kind of thing. I think in the middle layer we're going to see a tokenization piece, but also that coming together with AI, and particularly agentic AI. And then I think at the bottom, you're still going to need a really strong data layer. And the data piece, I think, is going to need to be rich and structured. And I think one crucial point, I think, about, if I then think about that sort of mental picture, if you like, I don't agree with people who say that we need to sort of start from scratch or tear everything down. I think we have many of these existing components, and we have many of the new components that are coming online, and I think the future's financial stack will be about combining those in the best way possible.
Yeah, if we wanted to do one sentence, right? No, I wanted to also say something nice about, say, Ethereum here, but I guess I'll keep it a little bit more conservative, because I agree with you as well. I think right now we're seeing a fragmentation of different layers emerging. I think it'll take time before we see convergence. I don't necessarily think we'll see just one layer emerge. I think there will be layers similar to how SWIFT came about that remain, say, credibly neutral, that people can interact with. That will, say, persist as, say, these larger, more credibly neutral layers. I think Ethereum, for instance, is a good example of a public layer that will coexist, perhaps with other ledgers and other layers that connect them. And I know that wasn't one sentence, but yeah, my takeaway generally is that I think that we will see convergence around some of the public chains and layers, and then we will see other layers that interconnect public permissioned environments, and that's, I think, how the future of the financial system will probably evolve over the next few years.
So I'm not going even to try to summarize it in one sentence, so I think I will also fail. So what helps me to think about like the future stack is actually the IMF asset model. Yeah? So it's very simple. So it just has like 4 layers. So it's a platform, it's the asset side, it's services, and it's access. And I mean, what we need to achieve in the end is to kind of consolidate and make it efficient at all 4 layers. And we also need always to remember we are competing against something that is actually working so, in status quo, and that has been built for decades already. Yeah. And so there are a lot of puzzle pieces that need to be connected, but the first layer that you need to start is at the bottom, let's say, yeah, but you also need to continue going up. And the bottom layer is the platform. And the naked, let's say the naked DLT, so to say. And if you look at the current state that we have in the market, so it's huge fragmentation. I mean, if it stays like this, then we can bury this and go back to that what we have and then say, okay, it's sufficient enough, so we will not top this goal. So the challenge is to manage it in a way, yeah, that these little small disconnected islands grow to larger islands. And not in a sense of I build a layer on top of it and then I try to create some sort of integration layer, because integrating a lot of fragmentation is, of course, very costly. So in the sense of growing larger islands and then integrate those and then create crystallization points for assets and then services and access follow. So.
Great. Yeah, so I had a hybrid, right? A hybrid model, also many layers coexisting together. Okay, so Marius, let's start with the public blockchain perspective. Why should financial institutions trust public infrastructure like Ethereum for core financial markets?
They should trust public chains that can show that they are credibly neutral. They should trust public chains that can show that they're globally distributed, that there's no single owner. I think that's, say, some of the main reasons for why people should consider credibly neutral public blockchains in the first place. And so important for these public blockchains that exist is to, say, convey to everyone and help everyone understand that these can be interacted with without no single counterparty being able to tamper with them or influence. It's a bit like when the internet came about, TCP/IP, that proliferated because it was credibly neutral, because it was open, because it was permissionless. I think we'll see the same for public blockchains generally. I think Ethereum has done a good job at living and adhering to some of those attributes. So I think that's going to be key going forward, as well as fostering and protecting the security, the resilience, the credibility, neutrality that you need in order to operate, say, a fully permissionless public blockchain.
If it's from the institutional side, when banks tokenize assets today, are they actually comfortable with this public chain, or do they still prefer a controlled environment?
When we talk about regulated environment, there is like one universal homework that you cannot neglect, and this is namely risk management. And then if you have, let's say, a use case and you need to do risk management in the context of this, let's say, use case in business. And then from this perspective, I would never kind of exclude like public permissionless or private permission, because it really depends on how you need to do this risk assessment. And if you now bring all properties that are required for a successful environment to thrive and scale, is like you need, it needs to be neutral, open, it needs to be utility, and it needs also to be compliant enough for the risk profile that you have for your use case. And for the first three, I would say public permissionless Ethereum is like the best example, like neutral, open, and not constraining or struggling innovation. So you see, like it's like an innovation jungle. So every day happens something new, but like in every jungle, you get eaten also easily. Like reading about, I don't know, 80 billions already being burnt or some bridges that do not work and things like this. And that's what I mean with the perspective of risk assessment. If you're just moving like $10 around, or if you have like a big risk appetite, like in the crypto space typically people have, then of course if you do your risk assessment and it will fit for the platform, you go for it. You have all the assets there, and that's it. But if you go back to the regulated environment, then this compliance optimized gets heavier, because you need to do your risk assessment and you need to know who's responsible for what, and it's totally okay to embed responsibilities into technology, right? But not everything can be embedded into technology, and for that rest, you need to know who's responsible for what. Yeah? And even in public permissionless settings, you have governance. You have like people like Ethereum Foundation. You have code developers. You have the miners that decide if they're accepting something or not. Yeah? And then we have also larger mining pools. So there is governance, but it is kind of grown bottom-up, merit-based, and is implicit. Yeah? And it is the main thing, actually, I would say, that is keeping banks back. Yeah? This implicit, merit-based, not really clear and not really written on paper. So what's actually happening there? And for this reason, the movement was started with permission blockchains and consortia chains, but they totally kind of constrained and struggled openness, neutrality, and utility perspective often also, yeah. And then it also did not work. And so what I think is the future for everyone to get more comfortable is to kind of always recall that it is about risk management and about risk appetites that you have for your use cases, and also public permissionless field to learn more how to support this risk management, and for permission field to learn more how to operate something as open, neutral, and as utility. Then, yeah. So I think that's currently, it's not fight like permission versus permissionless, so it's more like learning process that it is about risk management, and that you have different risk appetites and profiles, and that's still in a learning process, and I think we need a couple of more rounds to get this done.
Yeah, it's good that you mentioned the difficulty have this to scale. Perhaps you can turn to you, Ton, from the technology side. Are current infrastructures ready for large-scale tokenized finance, or we're still missing any key component?
I think they will be getting better and better, right? So where we are today is the worst that it will be, but I agree with Ivica. There are different use cases that have different risk profiles and also different requirements. If we look at running global payments on a ledger, including account-to-account payments to be more independent from cards and all of the things that we heard about earlier, we need millions of TPS on a blockchain, not hundreds, right? If you want to do settlement wholesale on a blockchain, you don't necessarily want a meme coin frenzy to freeze you for 12 hours and then for the transaction fee to go up 40 times, right? So the blockchains will be getting better, but I think there are very different use cases and very different choices that institutions, businesses, individuals, investors will be making which rail they transact on and how.
Nick, SWIFT's connected, trusted institutions globally. How do you view the public blockchain? So are they complementary infrastructure, or do you think they introduce any kind of risks to the financial market?
Well, maybe in answering that, I want to say, I pick up the point that Tom just made, because it's really important, right? There are many people in this room who run existing scaled infrastructures resiliently today, and we do that because we have to meet the expectations of our clients and of our customers, right? And those expectations, they don't just go away because we have another, funky new blockchain created, right? So we need to be able to ensure that whatever we deploy kind of continues to meet those needs and those requirements, and that has to be fundamental. I think, and I think Ivica made this point well. I think I'm sort of now at the point where I think we should sort of kind of reject this dichotomy that we've teed up between purely public and purely private. I think we need to get over that kind of thing, and we need to actually think about what roles do these different pieces of like technology and infrastructures created play in this new financial stack. And I think it's about getting now blockchains ready for institutional adoption. I think blockchain the communities like Ethereum and the EVM ecosystem have done a really good job at building, a base of developers and work which is well supported, and that gives a critical mass there in terms of a core technology, almost as the allusion to the internet here. But in order for that institutional adoption to happen, we then also need to build on the features that institutions expect. And just to take one example of that, the blockchain world tends to talk sort of sometimes a bit esoterically about privacy, but as I talk to global institutions, when they mean a specific thing when they talk about privacy, they basically mean, I don't want anybody in the transaction that's not in the transaction to see the details of that transaction. It's a very straightforward thing that they want. And so that's the kind of thing that we need to be able to deliver if we're going to implement blockchain at a scale for global payments. On the other hand, they really like the idea that we can see the state and we can see that the record has been there and immutable. So there is work to be done, and I think it is happening to bring that kind of level of privacy combined with the benefits of the the blockchain infrastructure and communities that's already been created.
Ivica, you mentioned earlier the Siemens bond, and we hear a lot about tokenization transforming capital markets. So what actually happening in practice today, and where are we still in pilot mode? So maybe you can give us some practical examples.
Yeah. So as I said in the beginning, so a lot of puzzle pieces to connect. Yeah. So and if we kind of look back and we see like we climbed Mount Everest, but then if you look up, then you see another Mount Everest you need to climb up. Yeah. And if I would need kind of to enumerate all these items, then I would say like primary market issuance works. Yeah, so this is okay. Now what is incoming and what is work in progress is secondary market, DLT pilot regime. So there is a lot of movement and payments of different kinds. Yeah, so I'm also not kind of when people say is stablecoin better than central bank money or tokenized deposit, I actually do not care about these discussions because you need these are different trade-off constellations for different use cases, and you need all of them. And we also always try to stay open also on this. But we need some sort of payment. And then, of course, all these things that I mentioned about infrastructure itself. And the last thing is also not to forget, we have financial instruments on DLT, but they still feel like second-class citizen, yeah, even if they have the same properties. Yeah? If we just think about eligibility criteria for giving this somewhere as collateral, for instance, at ECB. Right, so you fail right now, and I think we need to get this right. Like the platforms need to grow to larger islands. Governance need to be clear. Risk management needs to be clear on these platforms. Payments need to work. Secondary markets still need to work, and eligibility criteria. So digital assets becoming first-class citizen. It also needs to work. And we are now like since a decade and more on the way, and I think 5 more years, then maybe we're there. And if you compare, for instance, how long it took to introduce Target 2 or Target 2 securities, it was like decades. And if you think how long SWIFT also took from 70s to become like the standard for interbank message transfer, so it took also decades. Yeah? So we still have some work actually to do to be able to compete against status quo. Yeah.
Okay, so it feels like we are building multiple financial systems in parallel. So blockchain, we have the bank systems, the tokenization platforms, and the real challenge might be connecting them. So perhaps to you, Marius, from a public blockchain perspective, should interoperability be built into protocols or handled by the institutions? So how do you see this interoperability going forward?
Very good question. I think there's a few different answers to that, depending on who you speak with. Maybe one short comment before answering that, and just as a side note and a shameless plug, because you mentioned privacy, we do have our privacy team here today, an institutional privacy task force. Just to say that I think also acknowledge that this is a very important topic generally. So at 3 p.m. we're hosting a workshop on this actually outside for anyone that's interested. And I think for interoperability, I think that's still fairly nascent, I would say. There's a lot of exploration both on the protocol level, but I think also among service providers. There are different layers that are emerging now, exploring what will be the prevailing standard, if any. And so I think it's a bit early to say exactly what will prevail. I would say there's a lot of exploration, both on the blockchains themselves, but also say middle layers emerging, basically connecting everything. And yeah, we'll see how that plays out. I think there's exploration that needs to happen on both, and it's probably likely going to be a convergence where chains need to meet, say, service providers, infrastructure layers, etc. I don't necessarily think it has to be only, say, the institutional players that come and build out those standards.
Nick, do you want to comment on this interoperability layer across all these networks?
Yeah, I mean, look, it will be no surprise that I'm going to say interoperability is fundamental, right, to achieve here, and especially if we want this new financial system to, to deliver benefits over and above we have in the existing financial system, where maybe when national payment systems were built, they then thought about interoperability afterwards, and I think we should recognise that we have the opportunity now to think about it at this relatively earlier stage and come up with better answers, right? So I do think it's really important. I think we should be looking to try and achieve native interoperability between, between chains, between infrastructures. I think that should be based on standards. There would be no surprise that Swift would say it should be about standards, right? But to be very clear, we're not going to be the ones who necessarily create all the standards. I think that would be wrong. I think what we need to do is actually have a collective effort where we bring together a lot of these parties and take on, a number of pieces of important work that have done already. So, for example, we worked with ICMA, for example, to translate the bond data taxonomy into a use for tokenized digital bonds, right? And I think that's the kind of work where we can bring those things together. I think the other comment would be on this interoperability. There's a sort of technical aspect to the interoperability, which we definitely need to solve for. There's also the piece about, if interoperability goes wrong, and we've seen it with hacks on bridges, right? Who is responsible, right? And we need to establish that. That's, I think, is to your point on risk management, Ivica, right? We need to ensure that the responsibility is clear on that, and that through governance, through things like rule books, these are kind of like the not exciting things that are very fundamental to the functioning of a financial system. And we need to kind of figure those out too, because I think you're still going to need to be able to have an established trust and governance mechanism around that.
Tom, how is your perspective? So you think the interoperability is a technical problem, or it's more an institutional one?
I very much agree with what was said already. It's both, right? So if you look at somebody sends a stable coin and they want to move it to a different chain and make it a tokenized deposit, right? It's not just the technology that locks it up or destroys it on one chain and creates it on another one. It's also a business behind it, right? The reserve from the stable coin provider is going to move to the bank that now has the liability of the tokenized deposit. Same thing for assets and everything else. I think there's an exciting business opportunity in this. There will be key players that are going to be providing this interoperability between major networks. So for financial services providers, for intermediaries, this is a great opportunity. From a technology perspective, what we're focusing on is making it super easy for our partners to integrate with these technologies, and then make it super easy, reliable, and trustworthy to build the bridging technology itself, to make sure that everything can happen in a transparent yet very, very secure way. I also plug the privacy work that we're driving. We have a lot of researchers that are like key in areas like homomorphic encryption, areas like zero knowledge proofs, and so on and so on. So we're like very much agree with what Nick said about transaction privacy. This needs to be very much part of the discussion and part of the design.
Okay, so are we moving toward one connected system, or?
I think we've got to avoid fragmentation through this. Obviously, innovation inevitably creates fragmentation, but actually we need to converge this towards a more unified kind of system, acknowledging that the future will probably be multi-asset, multi-rail, multi-chain, right? But I do think it's got to be a system that is more integrated and that works together more seamlessly. We're playing our part in this, so we're bringing the benefits of blockchain onto the SWIFT network with a blockchain-based ledger that we're collaborating with 40 institutions from across the world to implement. So we're definitely kind of trying to play our part in this, but everything that SWIFT does is inherently collaborative, right? And so we're a big believer in the financial community moving together.
So if I
Sure.
may add to it. So about interoperability, I mean, it is easier to do interoperability if you have larger islands. If you have a lot of fragmented islands, yeah, then it's of course difficult. So that's the first thing. And even if you have just few, let's say, larger islands, it's still a challenge. I mean, I spent a decade in a bank working in integrating banking systems within one single entity, and then you end up with 3 to 5 different platforms and 10 different flavors how people want to integrate and which requirements they have. So it will remain messy. So there should be no illusion, I would say. But to repeat one more time, so it's crucial actually to reduce the number of islands that we want to integrate. And about the standards always, follow the volume. You know? So those guys that have proven that they can create volume, create gravitas, and gravitas leads to a standard. Yeah? So that's the way how it works. Yeah?
Okay, so we are agreeing that we are moving to a more connected system. So Nick just mentioned some things which SWIFT is doing. And in this case, who is responsible for making this happen? Maybe Marius and Ton want to...
Yeah, I can kick us off. I think it was mentioned already, but it is a collaborative effort. I think both protocols, public chains, users of those protocols, and anyone that interacts with the technology generally needs to conform around certain standards, be that for the ledgers themselves, for the assets, or how you interact with them from an access layer perspective. So that needs to happen. Otherwise, I would say, why would we be here? We're kind of in the process of redoing the financial plumbing and infrastructure, and we have a great technology available to us. It would be a shame if we end up with, a similar fragmented banking system. So I think the aspiration to work towards something that is more interconnected, more efficient, should be shared by, say, all industry participants. Yeah.
I think I largely agree. We said earlier, or Ivica said that the ecosystem, some of them will have more gravitas, more gravity, and so on. I think this will come mainly from the value that the ecosystem starts to generate for the founding users, or the users that start transacting, right? And the higher the value, the easier it is to integrate more capabilities in terms of settlement, in terms of AI, in terms of everything else. The bigger that ecosystem will grow. For the standards to emerge, it's really, really important that they're credibly neutral and that the technology just works underneath, right? So that people don't have to worry about them. And so I think this is the way that things will develop. The ecosystems will grow commensurate with the value that they're creating for the joining members, of the members who are already on the network. And then the bigger ones will have obviously more say in defining the rules and the standards for the broader group.
Great. Okay, so let's zoom out a little bit. If you look 10 years ahead, I know that everybody is agreeing here. So perhaps what will disappear or becomes irrelevant?
Manual reconciliations and long settlement times. I think we've got to get rid of all of those friction points, right? That's the kind of benefits that the end customers, end clients want to see. I hope we will also get rid of the genuine, and try to express this in the right way, but I hope we also get rid of the buzz around AI, because I think AI will become actually core to this, because this isn't only a discussion about chains, there's a discussion about all of these kind of technologies being combined. And I get excited about the idea that the programmability that you get from tokenization could then work with AI agents actually intelligently managing them. That's where I think you start to see real excitement.
I very much agree with that. So blockchain gives us capital efficiency, right? You can move money and assets around the world very, very flexibly. The amount of working capital that you need goes down. Your clients are much more happy with the level of payment and settlement services that they're getting. So capital efficiency through blockchain is clear, but I think there's an entire kind of process redesign that's going to come as a result of AI. You look at marketing companies, they used to pitch an account, win the account, and then they used to do work, and then they would sell or propose a campaign for the account. With AI, they no longer have to do that, right? They can just build a campaign in an hour, and they can go sell that campaign. This is going to be similar for finance. If your agency's public filings, they see internal bank data, they see Bloomberg feeds, and they see the stock of portfolios, positions, assets you have on Ledger, very easy to make tailored hedging strategies to optimize the flow of capital and so on and so on. So we're seeing this already with some partners that we're working with, and this is going to be a thing that completely unlocks operational efficiency, and where finance processes might even have to be redesigned because things that were not possible because of friction and costs and so on suddenly become possible. So that's where I think this is going. There will be a lot more robots paying robots with all the things that we talked about earlier, things like verifiable proof of delegation, things like payments that they need to be able to execute autonomously. This may even increase the size or number of transactions that we're seeing by multiple folds. So this is going to be one area, and the other area where it's going to be quite significant is how do the processes actually change when a lot more is possible a lot faster.
Maybe I go on. So, and maybe turning the other way around. So what will not disappear? And I would say roles and responsibilities will never disappear. So no matter what you do technologically, you just kind of shift them around and you embed maybe few of them into technology, and people forget it because it's under the hood. But roles and responsibilities, they never disappear. So they're always there. And but what I'm expecting to happen is that the platform layer itself is going to become some sort of commodity or utility in a wider sense, because people will recognize that it is not contributing to competitive differentiation anymore. So it's like for the benefit of all, and then competition happens on the layers up above, on asset layer and service layer and access layer maybe.
Yeah, I'll conclude by saying that I think it's from an infrastructure perspective as well, and now talking about blockchains, I think it's important that we protect, let's say, the credible neutrality of some public chains, so that they remain available to everyone, and so that they can truly act as global financial settlement layers. In 10 years from now, I hope that you don't have to think too much about it. I think hopefully a lot of that will be abstracted away, so that what the end customer sees in the end is just an interface, and then all the plumbing or the complexity happens in the back end, and you don't necessarily care anymore if you're operating on, say, traditional financial rails, or you're on a blockchain, or a combination of both, and what that looks like. So that's the 10-year vision, but it'll take a while to get there. Yeah.
Great, we are right on time. Yeah, and we heard different views, and it's clear that the future of financial stack won't be built by one player alone. We heard a lot about collaboration. Thank you so much for the great discussion, and also thank you for the audience. Enjoy the rest of the conference.